Since the summer of 2022, the private equity industry has faced a number of challenges. Off the back of rising inflation, higher interest rates, and recession fears, global deal making is edging towards a 10-year low. But what does that look like for the equity co-investment model?
We were actually up 30% for the year, despite the markets being down. So we've seen over 1,000 transactions this year.
That's Ken Binick, Managing Director and Global Head of Execution for Hamilton Lane's direct equity platform. Prior to joining Hamilton Lane in 2023, he spent 15 years at Portfolio Advisors, where he served as co-head of co-investments, having played an integral role in developing the firm's direct equity co-investment initiatives, which led to him successfully executing over 100 equity co-investment transactions during his tenure. On today's episode, I will ask Ken to provide real-time insights into the current private equity market landscape, touching on fundraising, valuations, exits, and deal-making, as well as give us a sneak peek into the exciting world of equity co-investments. I'm your host, Fabio Montaigne, and this is Private Markets Made Human, the podcast from Hamilton Lane that breaks information and perspective from our greatest asset, our people. Ken, welcome to the podcast. I thought we could kick today's episode off by asking you to give our listeners a high-level overview of the private equity landscape today, how it has evolved, and how it's broken down.
Sure. Well, first of all, thanks for having me. It's a real privilege to be here. I've heard a lot of great things, so thanks. In terms of the private equity landscape, I mean, that's obviously garnered a lot of attention over the last several years and has grown quite significantly. I think not only from the companies that are looking to access the private capital, but also for investors who are looking to diversify away from public markets, and rightly so, right? If you look at the returns over a long period of time, if you go back 15, even 22 years, you can see the outperformance and in some ways a pretty significant margin. So, that is, I think, is going to continue. That the private equity market in general is sort of broken down into venture, growth equity, buyout, and then you have a little bit of distressed as part of that market in general. The buyout market being the most significant of those.
It'd be great to get some real-time insights from you on how the industry has performed in the last sort of 12, 24 months. Maybe starting with fundraising. Could you shed some light on how this has trended?
Yeah, make no mistake about it. It's been difficult. I think across the board, anyone who's been lucky enough to get in and out of a fundraise with a one and done, I think that's few and far between. I think in general, it's become quite a challenge for folks. It's definitely gone down over the last couple of years. That part of the market and that dynamic is actually really beneficial to co-investors, and we could touch on that a little bit later. But fundraising has been very challenging. I think the exit volume has come down quite significantly. So I think that's tied hand in hand to investors making new commitments. If they've got capital tied up in assets, and it's really hard for them to kind of move along and make an additional commitment to a fund that's out fundraising right now.
If we were to maybe think about a pretty hotly contested topic, valuations, we've seen quite some volatility in the public markets in the last 24 months, S&P falling 20% or so in 22, rebounding just over 20% in 23. How have PE marks valuations evolved in light of this?
Good question. I mean, obviously there is a correlation there. I'd say generally when you look at buyout, I think asset values remain high. They have come off a little bit depending on industry. I think if you go down to more of the growth equity and venture type transactions in the tech space, I think those multiples have fallen off pretty considerably. But there are less and less transactions getting done right today in terms of expectations between buyers and sellers. The ones that do end up getting transacted on more often than not are sort of the better performing assets, or what I would call grade A, and therefore have fetched some higher valuations.
Moving to deal making, you mentioned exits are trending downwards. What does that look like for deal making? How are we doing? I guess relative to 21, which was a record year. 2022 was a little bit softer, let's say. What's that shaping out to be like in 2023?
Overall, deal volume has been down pretty significantly across the board. I will say you wouldn't be able to tell if you looked at the deal volume that we have internally here at Hamilton Lane as it relates to direct equity. We were actually up 30% for the year, despite the markets being down. So we've seen over 1,000 transactions this year. But in terms of the general market, there's just a disconnect between buyers and sellers right now. I think, anecdotally, you speak to a lot of GPs out there, and I think they haven't been able to adjust, right? They think that their assets are worth a lot more than I think they would trade in today's environment, just given leverage levels, interest rates, some of the uncertainty, and they're not ready to sell. The buyers out there are expecting a little bit of a discount. So, I think that kind of clears up a little bit. As there's more clarity. I think there's also been a message delivered to GPs. Hopefully, it's been well received or heard. But I think any investor that you've talked to over the last several months has been very straightforward with the fact that they want to see distributions. And so, I think GPs holding on to an asset that's performed, looking for another half turn or a turn. I think having heard that message, I think going into 2024, hopefully they'll be more inclined to sell those assets and to listen to investors.
I thought we might shift gears slightly here to delve a little bit more into the world of equity co-investments, your world. It'd be great if you could kick this off by providing an intro to Hamilton Lane's direct equity platform.
I've kind of snuck in a few of those co-investment highlights along the way. So this is great to be able to highlight it in a little bit more detail. We've had co-investing at Hamilton Lane for a long period of time. Really from the start of things at Hamilton Lane. So if you think about, we've got about 30 years of experience doing this. If you look at the current state of our platform, we've got 40 investment professionals that focus just on this strategy, and that's global. We've got about $14 billion under management. We've executed 580 deals. So there's quite a bit of experience and data that goes into this, and that platform executes on a number of different strategies, right? We do have venture. There is an element of growth. And when I say 40 professionals that are dedicated, I just want to stress that co-investment in general is a platform play, right? And so if you think about those folks that are dedicated, that's in conjunction with the rest of the platform. So, the backbone of the whole co-investment industry and Hamilton Lane is really the primary relationships. So we have 60 investment professionals on that team scouring the market, forming very strong relationships in those arenas. And that's really where it all starts, right? And that's where the deal flow comes from. That's where the expertise starts. So when you think about that, there's a very powerful engine in terms of how we source, how strong our relationships are across the firm.
That's super helpful background. And, we talked about it earlier. You mentioned deal flow is up considerably in 23 relative to last year. Is it curious to hear why you think that is the case? Is that down to our sourcing engine? Is that down to our focus in the middle market? It'd be great to understand that a little bit more.
Yeah, certainly back to some of the dynamics we touched on earlier, right? Which is there's a void to be filled in terms of equity, just given the current state of the credit markets. But to your point that you just mentioned, it is really the sourcing engine. So if you look around, I think the industry, and you look at our primary capabilities, I think it's the strongest, or at least one of the strongest platforms out there. We put $35 billion of primary capital to work last year. So that tells me, we've got 500 plus GP relationships across the market that we're in contact with on a pretty regular basis. And then if you add further to that there are actual formal sourcing processes in place and objectives and projects, that really leads you to what we were talking about before, where the funnel increases and we just become a more strategic partner to our GPs, just given our size and the amount of capital that we can provide as well. So I think all those factors are really pointing to that increase.
Interesting. Yeah. So private equity deal making down. However, we've got a slower fundraising environment and arguably a much lower appetite for leverage, which is creating a capital gap where equity co-invests can come in play. It'd be interesting to hear about maybe some of the key characteristics we look for in a transaction.
I think one of the real highlights for co-investment, right, is the diversification, right? So I think where we start is let's partner with the strongest relationships we have, the best relationships we have, and who are experts in the space in those particular sectors or subsectors. And to me, that generally mitigates or removes a layer of risk, right? Because now you're scouring or sourcing from a private equity market it's a risk asset, but now you've mitigated that layer, right? You're sourcing from the best, or what you believe is the best. I think, the deals that we execute on are from, I think it's 73% of the deals are from first or second quartile sponsors, or the funds are. To me, that's pretty impressive, and you're sourcing and executing from a very impressive, attractive pool of assets. When we look at deals, and especially in this environment, I think you've got to find deals and assets that have multiple levers to grow. Certainly, you're going to be challenged here in this environment with multiple expansion. I don't think that's going to happen. To a large extent, financial engineering with leverage is been removed, and I think we all have to assume that today's state is sort of the new normal. And so, where does that leave us? We really need to have. I think it's going to be more important than ever to find strong organic growth and different ways to execute on that. But then I think on the other side is you almost have to open up the old playbook and start looking at costs and margins, optimization, enhancements on the cost side to really start adding value. So we want to see all of those, and we want to see multiple different levers that we're able to pull, just because the market evolves constantly, as we've seen over the last couple of years, right? So you really want to remove yourself from being a one-trick pony, if you will, and be able to pivot midway, right? These are long hold periods, so we want to have the ability to pivot midlife during the investment. And then I think lastly, what we're really trying to focus on is capital preservation and downside protection. So, I think anybody looking to invest in a co-investment fund, they're not looking for us to get the venture-like 5x, 6x returns. I think they want steady, consistent returns with where they're protected well on the downside. So we'll take our 2.5 to 3.5 times return, and we want to make sure our loss ratios are very low.
Interesting that you touched on returns there and mentioned the multiple expansion. It's clear that with a low interest rate environment, private equity has benefited tremendously from that. And I think I read a stat somewhere that multiple expansion has accounted for a good chunk of the value there. In your opinion, with this sort of higher rate environment probably being here to stay, do you think it's realistic to expect similar returns as delivered maybe in the last 10, 15 years?
I mean, I guess I'll start off. It's always helpful to start off talking about things on a relative basis, right? So when I look at the private equity markets vis-a-vis the public markets, I think they'll continue to outperform, right? History will tell us that. I think if you look over the last 20 plus years, it's very consistent that they do outperform. I don't see any reason that won't continue. Now, when I look at returns specifically related to private equity, I think you're right. I think the financial engineering part has gone away. Multiple expansion has gone away. Now, that I think there's just going to be a larger dispersion of returns, frankly. I think we could still hit those targets. Not all managers are created equal. And I think it's going to be more important than ever to align yourself with the best managers because, we touched on it a little bit earlier. I think it is going to be about execution. How do you go in there and execute on not only M&A, right, but really strong organic plays? And how do you go in and enhance your supply chain or rationalize your cost structure in an appropriate way without impacting the top line extensively, and really having the network to bring those experts in. So, I think it's going to be harder, but I think those returns are certainly achievable.
And I think one interesting thing that I read as well is obviously the current rate environment isn't too dissimilar to what we had prior to the GFC. And that was a period where private equity performed extremely well too. So I think, as you said, opening the old playbook is what's probably going to have to happen. What about HL's thematic approach? Are there any industries we avoid?
That's an interesting question. Look, I think the thematic approach is an interesting one, and certainly from a co-investment perspective, I think it's hard to drill down and say that here are the themes that we have come up with and are going to execute on, because the reality is the experts are the GPs that you're aligning yourself with, right? And they're coming up with the theses around that. And the beauty of co-investment is that we get to see everything. We are on the front row. There's communication across this firm. Between secondaries and primaries and co-investing. We're having hundreds of meetings a year where we're talking to GPs and understanding, their playbook, what they're seeing in the market, and that's all being communicated back to us. So, we're constantly evolving. We're looking at different sectors, probably the same sectors, but different subsectors in every 1 year. And the beauty of it is that we can pivot and transition into different subsectors based on the experts within those industries, and we have access to them. If you look at sort of the market, I know our data suggests that when you start to break down industry and subsectors in any one given year, from year to year that changes, right? So it's good to be diversified. It's good to be agile and to be able to pivot throughout the investment period. To your question on industries we avoid, I mean, I'll speak for myself in some sense. I think, restaurants are a little bit difficult for me to swallow, especially, when you think about new concepts in general. To me, it's a little bit of lightning in a bottle. So that's a harder one or a higher bar for us in terms of getting comfortable there. And we want to make sure we limit our exposure. That's not to say you can't execute well, and we have sponsors that have done well there. So I don't want to discount it too much. And I think if you look at sort of consumer discretionary, I think that sector can do well. I think where we really want to focus is around fad risk, having sort of a single product. I think those two areas are where we tend to stay away from. And then I think just energy's been pretty volatile. So we for the most part, especially in E&P, we stay away from it.
Thanks. That's a helpful background. And now just thinking about probably the biggest buzzword for 2023, AI. Curious to hear how that's impacting our decision making.
Well, certainly AI is not making the decisions for us at this point, unless Eric and Juan have something up their sleeve. I don't know, but in all seriousness, we are trying to utilize AI as much as possible in in terms of our investment process, and trying to streamline things and make things more efficient so we can focus our attention on some of the things that really matter. So that's one element, and we continue to look at that. As you know, just from a Hamilton Lane perspective, we are on the forefront of technology, and that continues to be the case. I would say from an investment perspective, AI is part of every discussion, and it needs to be. So now that's not to say I think we have to be careful not to get caught up in the AI hype in every industry or sub-industry, because while it's always on the horizon and a risk, it doesn't necessarily mean that these companies are going to be displaced, and at least in the near term or even in the long term. I think what we're looking for is companies that are sort of embracing that change. So to some extent, there is AI involved, even in the sleepiest of industries and businesses. And how are they embracing that for the next turn? And so that's a really important element in discussion that we have in all of our ICs. You also want to look at things from our perspective. We say, okay, here's how the business looks today. Here's how we should execute. Here's how AI is going to impact the industry, now and over this period. But how does this all look at exit, right? Because we have to be able to sell a product in a company at the end of our 5-year hold, right? So looking at a little bit more is difficult, but you have to make sure that you're thinking about it and hedge that risk appropriately.
No, thanks. That's interesting color. I think, AI is definitely a risk, but an opportunity. And exactly as you said, don't get on the AI hype too much, right? I think people overbake it sometimes. Like, Ken, this has been super interesting to get under the hood of both the private equity landscape and more interestingly, probably for myself, and I'm sure the listeners, the world of equity co-investments. Just as a wrap-up question, I'd be very interested to hear your views on what do you think the industry needs to happen for private equity deal making, exits, fundraising, etc., to regain the scene that we had prior to 2022?
I think the table has been set to some extent. Where we mentioned before, I think the message has been very clearly delivered to GPs that LPs want exits. They've been holding on to assets for a long time. It is important. It's important to returns. It's important to their investors. I think there's a lot of pent-up demand. And so I think that disconnect between buyers and sellers is getting smaller. And so that is setting us up. I think what we've seen anecdotally is in the private credit markets, that pricing's coming down a little bit as well. So I think that helps enhance momentum. And so we do have the makings here of I think a better year for sure, and an increase in deal volume. There are still some things out there that could potentially get in the way of that. I think critical to that is making sure that inflation continues to be managed correctly and is not worse than what we're expecting or seeing right now. In which case, interest rates will be a little bit more manageable. I think if we can keep inflation at bay, we can keep interest rates stable at least, and not in an increasing environment. I think you're going to see volume start to increase pretty nicely for 2024.
Thank you, Ken.
Thank you.
Thank you for listening to another episode of Private Markets Made Human. Please stay tuned for our next episode.